In this video, we will illustrate the straight line method of amortizing both bond discount and premium. Using the straight line method of amortization, we allocate the same or equal amounts to each interest period. The calculation is the amount of the bond discount or premium divided by the number of interest periods. In this example, the company sold $100,000 of 10% bonds for $92,639. This resulted in a bond discount of $7,361, which is the difference between the amount of bonds payable and the amount of cash received. The amortization of the discount is $1,472 for each of the 5 interest periods. This is found by taking the discounts on bonds payable of $7,361 and dividing it by 5 interest periods or 5 years. For simplicity, we rounded to the nearest dollar. This amount, $1,472, will be added to the interest payment to arrive at interest expense. The interest payment is $10,000. This is found by multiplying the principal or par value by the contractual or stated interest rate of 10%. The bond discount amortization is $1,472, and the interest payment is $10,000. The journal entry on December 31st results in a credit to discount on bonds payable for $1,472, as well as a credit to interest payable for $10,000. The debit is to interest expense, which is the sum of $10,000 plus $1,472. The amortization of bond discount increases interest expense each period. As the discount is amortized, its balance declines so that the carrying value of the bonds will increase until it reaches its face value at the maturity date. Now let's assume this company issues these bonds at $108,111 rather than $92,639. The entry to record the issuance results in a credit to premium on bonds payable for $8,111. The amortization of the premium is $1,622 for each of the 5 interest periods. This amount was found by taking the premium on bonds payable of $8,111 and dividing that by the 5 interest periods or 5 years. For simplicity, we rounded to the nearest dollar. This amount will be subtracted from the interest payment to arrive at interest expense. The interest payment remains the same, or $10,000. The premium amortization is $1,622. The journal entry on December 31st results in a credit to interest payable for $10,000. We also need to debit premium on bonds payable for $1,622. The last account is the interest expense, which is found by subtracting the $1,622 from the interest payable of $10,000. The amortization of the bond premium decreases interest expense each period. As the premium is amortized, its balance declines so that the carrying value of the bonds will decrease until it reaches face value at the maturity date. In this example, that is $100,000.